This is Fintech Insider News. This week, tariff turmoil. What might be the impact of the changing international tariffs on fintechs and IPOs? Research from HSBC Innovation Banking shows early-stage investments dominate the UK term sheet. And Toulouse lets customers pay for travel with crypto. We'll be discussing all of this and much more on today's show, so don't go anywhere.
You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon's Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Hello and welcome to episode 953 of Fintech Insider. First up, on this week's pod, we have a Fintech Insider return for Sophie Winwood, co-founder and CEO at Unlock VC and operating partner at Foxe Capital. Sophie, it is always a pleasure. How are things with you and both Unlock VC and Foxe Capital?
Yeah, very good. Very excited to be back and great to be on with you, Ross. It's a wild time. We're about to go into it, but yeah, it's not boring, is it?
No, definitely not. And you're right. I think we are about to get into it in some depth. Next up, we have Alex Johnson, founder of Fintech Takes. Alex, how are you? How are the beautiful mountains in Montana?
They are good. It's spring, so the mountains are still covered with snow, but the valleys are nice and relaxed and calm right now. So everything is good.
I like that bit of optimism, especially based on what we're about to get into in our first story. And last but not least, a warm welcome back to the podcast for Sarah Kocianski, CEO of Fintech Wales. Sarah, I know that number 953 episodes always startles me. I'm sure it startles you as well.
Yeah, I can't believe it. I mean, obviously I haven't done every single one of those, but I remember when I started, we were episode like 30 or something. So it's amazing to be back.
It's great to have you. How are things going? I know you've recently launched an accelerator and got some exciting things.
Yeah, no, things are going really well. Thank you for letting me do a little bit of a plug here. So we've got the Fintech Foundry, which is relaunched. It's Fintech Wales' no equity accelerator. It's for companies that are based anywhere who want to come and be part of Wales' thriving fintech community. It's 5 modules across 6 months delivered in Cardiff. We're really, really heavily driven by mentoring and coaching this season that is totally bespoke to the needs of the individual companies. So we're looking for startups with an innovative solution that have aspirations to grow, to come to Wales. So if that sounds like anybody listening, then please do head to Fintech Wales' website. There's an application form. You do need to do it by Wednesday the 16th. But if you've got any questions, then do please just get in touch with me and I'll answer them as quickly as possible. And thank you. That's it. That's the plug, I promise.
I love that. Excellent plug. Do get in touch with Sarah. All right, excellent. We have an excellent panel, if I do say so. So let's jump into the news. Now, our top story this week comes from FinExtra with a headline, Tariff Turmoil, What Might Be the Fallout for Fintech? So Klarna has paused plans for its initial public offering that was filed last month amid market turbulence sparked by President Donald Trump's tariffs. The firm is reported to be looking to raise in the region of $1 billion with a market valuation of $15 billion. A roadshow ahead of the IPO is set to begin on Monday. However, the plans are now on hold as markets tumble following Trump's announcement on tariffs on US imports. Circle, the stablecoin giant, who filed last week, has just as quickly paused their IPO in the wake of the tariffs. And these are just the initial first responses. Tariff charges from both Trump and other markets responding to his tariffs are changing every day. And on the Trump side have also been rolled back for 90 days, with the exception of China, instead imposing a 10% import tax rate. As such, it's not worth us recapping the specific numbers as they stand today, as they could be outdated by the time we publish the episode. But it's safe to say that stock exchanges globally are in turmoil. I mean, look, it's been an intense roller coaster ride since President Trump announced this raft of tariffs on what he coined, quote, Liberation Day. Alex, as our resident North American, I suppose it's only sensible to come to you first. What's your reaction to what you've seen over the last week or so?
Oh, God, I feel like I have to start by apologizing. I don't know what's happening. I am so sorry. None of us have any clue what's going on. So I would just like to say off the top that on behalf of all Americans, I apologize. We really are not thrilled with this. But yeah, I mean, we're not feeling overly liberated. I guess if you were planning to go public and you were stressed about that process, you've been liberated from that stress. So that is, in some senses, a good thing. I mean, look, the IPO part of it and the connection to fintech, I think just really relates to certainty versus uncertainty, right? And there really just aren't that many windows for the markets to take new companies in where there's a level of certainty about what the response is going to be to that. And you have these kind of windows of time that you're planning for, right? And if you're Klarna, I mean, Klarna is a much older company, I think, than a lot of people appreciate, right? They've been around for a long time. They've been on an incredible journey that's included SoftBank throwing, huge piles of cash at them, taking down rounds when interest rates went up. So there's been a lot of back and forth that's been happening. And over the last couple of years in particular, they've really been trying to move all the chess pieces around so that they can go public. And yeah, I think what ended up happening was they were thinking about, hey, we're going to start going on this investor roadshow on Monday. And what they were told by their bankers and their advisors through this process was, no one's going to be in the boardroom on Monday to hear you, right? Because they're all busy trying to figure out everything that's happening. So even though the reciprocal tariffs have been paused for 90 days, as you mentioned, Ross, I don't know that anyone feels or should feel like that 90 days is going to be set in stone. That could change, as you said, very, very quickly. The trade war that we seemingly have started with China is likely going to escalate. And I just think that the level of uncertainty that exists, even with this 90-day pause, is going to make it very, very difficult for investors to think longer term. And that's what you need for an IPO or for a company to go public.
Yeah, I mean, Sophie, to Alex's point about the chess pieces and the work that's gone in for Klarna to get sort of IPO ready, I mean, all of this is terrible timing, right?
It's just so sad because as a fintech investor, we were so excited about this year. I mean, there's Klarna, Stripe. It really was sort of looking to be this big unlock of capital. And that is important for the public markets, but it's also really important for the private markets because the venture capital industry needs returns. It needs liquidation to work. And we just haven't had that for the last couple of years. And things are starting to get really difficult. And if we don't see kind of capital flowing through the, from these IPOs and acquisitions back into the ecosystem, then funding is going to get harder lower down the train to your pre-seed, your seed startups. And so, what's so funny about this is you think, okay, well, fintech, we're fine. We're not impacted by these tariffs, right? It's automotive, it's pharmaceuticals, it's semiconductors. But it's so much broader than this because of the interconnected global trade center and because of the markets that, unfortunately, no industry is going to be protected from this.
It's such a great point, right? These things are cyclical. You unlock that funding and then that gets reinvested in earlier stage ventures, and so the cycle continues, and so there's a long tail there, I think, that we're yet to see. I completely agree with you. I mean, we were absolutely thinking that 25 was going to be the year of the IPO. It was Klarna, it was Stripe, as you mentioned. I mean, we mentioned as we ran through the story, Circle, but also the likes of Chime and Zopa that will have been keeping an eye on the market. There've been rumors flying there. I mean, Sarah, what's your reaction to this? I mean, it is a lot of uncertainty, and it doesn't look like that's going to get cleared up anytime soon.
Yeah, I mean, my instant reaction to it is sorry, what? What? Every time I turn the news on in the morning, I'm like, sorry, no, hang on, can we go back a bit? Because like I've only been asleep for 8 hours. I think the point, the salient point, and the overarching point that's already been made here a little bit is that markets hate uncertainty, and investors don't really like uncertainty either. I mean, Sophie can probably back me up on that, but it's not a great position to be in, and we are in more uncertain times than I think I've ever seen, sort of in terms of being like an adult working in the fintech industry. I don't think I've ever sort of had this thing where I literally don't know what it's going to look like when I go to bed every night, as opposed to like, one night with maybe some of the big votes, the Brexit votes, or the elections in the US. So that uncertainty is really disappointing. It's going to continue for quite a while, I think. I think from the perspective of kind of the impact on fintech, I think there's the investment piece, which Sophie's so clearly articulated. But I think the other point that we need to think about is that if this pitches us into a global recession, that affects everybody. Literally everybody. Well, maybe not literally everybody, but, let's take 99.9% of the global population. So that's going to mean, people have less money to spend. That's going to mean people have less need for financial services, or a lot of the financial services. It means people can't be able to afford their loans. They're not going to pay off their credit cards. They're not going to be investing because they'll have no money to invest, and the markets will have crashed, and all of that will affect the fintech industry. And I think to sort of take that a little bit further as well, and saying that this affects everybody and that there is that long tail. When you have a global recession, it's the less affluent regions that are always hit the hardest. And from a Wales perspective, we're already kind of, far less affluent than if you're looking at London, for example. So from kind of, that's a few points tied together, but I think the overarching piece is uncertainty, global recession are going to affect everybody, and that's going to affect every industry across the board. But when you take it back to fintech, a lot of those financial services products are reliant on people having some money or some ability to repay debt if they, are in that position.
I just wanted to pick up on that point, Sarah, is the also big impact on uncertainty is that big corporates and banks pull away from innovation programs. They stop doing anything new and they just focus on the core, head down, let's get through this. And in the last couple of days, I've heard portfolio companies just had POCs pulled, had funding pulled. And so it really does impact, the fintechs that are really at the point of breaking through. Are just not going to be able to work with large banks because they've got, a lot of other things on their mind at the moment.
I think, sorry, Ross, just to follow on from that point as well, whenever things get hard, the two things that get cut first are research and kind of like, talent acquisition, kind of hiring pauses. And I think that research point has always really frustrated me, not least because of my background as a researcher. But how are you going to solve the problems that this throws up if you've got nobody looking at those problems and potential solutions? And that kind of can often hinder innovation across the board, whether it is, to Sophie's point, within the large financial services organizations, or even if it's kind of, when you've got grant funders pulling back on what grants they're giving to innovative projects. And those projects are often kind of right at the cutting edge or serving particularly niche or vulnerable communities. And that grant funding gets pulled, you're kind of left with this gaping chasm of nobody funding those really, really necessary innovation projects.
I think that's such an important point, because it's so easy to just think about this in terms of funding and capital, but actually it goes so much further. It's opportunities for emerging businesses to partner and scale, and all of that contracts. Alex, one thing, I suppose, touching back on Sarah's point about a recession, one of the theories that has emerged and probably gained some traction is this idea of sort of disruption and uncertainty by design. This idea that Trump is intentionally trying to crash the economy, to force a recession, to reduce bond yields and the cost of refinancing US government debt. It's probably interesting, shall we say, that he came out and announced the pause once they started to sell off, once investors started to sell off US government bonds. It was when it hit the bond market rather than the stock market. Do you think there's anything in that?
Yeah, I definitely do. I mean, the story I've seen reported is that Jamie Dimon went on Fox News and basically explained in plain language why investors selling bonds, which are U.S. Treasury bonds, are the safest asset historically that there ever has been. Even when there's whatever economic disaster is happening, people flee into Treasury bonds. As soon as you start seeing investors flee out of Treasury bonds, you have a totally different level of problem. And apparently that interview on Fox News was seen within the White House, since they watch Fox News a lot. And that apparently is sort of what backed us away from the cliff a little bit. But yeah, I mean, I think the thing that's really sort of interesting is, and this relates to the broader point about uncertainty, I think sometimes we try to sort of impose larger ideas strategically about what might be driving these actions onto the current administration, when in fact, all I think the practical indicators are that it's really something that's done much more based on instinct and based on vibes at any one moment. And so, again, the challenge is, if there was a larger strategic plan that we were going to impose and stick with, even if it did have economic consequences, right? Like, hurting the stock market, potentially driving us closer towards a recession. Like, if there was a plan that I think the markets and investors felt confident in and could sort of plan around, and companies could plan around, at least that would sort of unlock that uncertainty. But because the way the administration is approaching this seems to be based much more on sort of a real-time vibe check of, how is the market approaching this? What does Jamie Dimon think about this? What are they saying on Fox News? There's so much moment-to-moment chaos that I just don't think that uncertainty is going to go anywhere. And so certainly, the markets rebounded when President Trump announced the 90-day pause on reciprocal tariffs. We started to see kind of the bond market sort of slide back to where it had been before. So the market's definitely calmed down as a result of that. But I don't know that we should mistake a slightly calmer market reaction to what's been happening recently with the attitudes that investors and executives at companies probably have, which is, I still don't know that I can trust the environment to make long-term investment decisions.
I was going to say, when you're describing that, Ross, that sounds entirely too strategic from what I understand is happening over there. But that may be a very cynical view.
I think it's an accurate view, sadly.
Well, I think it's kind of illustrated by the fact that the administration, and by the administration, I mean President Trump, has sort of taken his usual approach to managing this, which is through his social media platform, Truth Social, writing "be cool" in all caps, and it's kind of like, I think when you write "be cool" in all caps, it kind of comes across as anything like, sort of like you're calm and cool. It's kind of like, you're sort of like, let's not get carried away, shall we?
Right. Yeah. It's like asking, is my money safe? Like, as soon as someone asks the question, you're already way too far down the tracks. And so, no, I completely agree with that.
Exactly right. And look, I think as well, Sophie, I think Alex's point about the markets is an interesting one. I mean, obviously we saw like really steep declines when the tariffs were first announced. I think, in some places sitting in sort of like bear market territory, certainly correction territory. And then we've saw, since the 90-day pause has been announced, we've seen a lot of that sort of ground be recovered. But I think at the time of recording, and we record this on a Thursday afternoon, the markets are sort of down again, certainly in the US. And so that sort of just illustrates that almost like the markets don't even really know how to respond, even in real time, to what's actually happening, right?
Yeah, and again, to go back to Alex's really well-made point around, when you don't know what's going to happen, it's very hard to plan. And I think you're seeing that in the markets, which is, no one really knows how to feel and what to do. And so I think you'll continue to see this volatility. It feels to me a little bit like COVID, where we sort of had that big crash and then people were like, oh, it's actually not as bad as oh no, wait, actually it's quite bad. Like, I think we'll continue to see this dip and, rise. And this is absolutely not investment advice, but, just hold still on, don't make any rash decisions unless you absolutely have to with your assets, because it's not over yet. And I think, especially if we're looking at fintech and banks, again, you might think, well, why are banks they're not impacted by tariffs at all? But obviously banks are way impacted by the macro economy. And if we're all, if Americans are buying less because things are more expensive, if we get more inflationary environments, if companies aren't doing as well, they won't take on loans, etc. So I think banking is a real sort of view of how the whole economy, the stock market, kind of stocks within banking, is such a view of how the economy as a whole is reflected. And so, we're just going to continue to see this volatility, and that's going to impact banks, it's going to impact fintechs, and it's going to impact venture as well, which is, venture is, what's the tough thing about venture is how do you price an asset in these markets? It is very, very difficult. And if you can't price it, then, you tend to be a lot more cautious. And that means that capital just won't flow as freely as it would be in a more stable market.
Yeah, I completely agree. And also what you said about, this is not investment advice, but, don't probably jump in sort of head first right now, is timely, because there is an obvious temptation right now to, quote, buy the dip. And I think people need to be really careful there because, we're not out of this yet, right? Sarah, what do you think in terms of how this manifests in some of those smaller regional hubs, obviously Wales being an example?
Yeah, I think, it's the point I made earlier that, any kind of recession or kind of, slowing growth or even negative growth does affect less affluent areas, more than it will affect people who have got, larger buffers around them. I did have a look actually and see kind of if there are any specific Welsh industries, just out of interest, that this would impact. Because for those who don't know, Wales has got quite a heavy manufacturing industry historically. And apparently 13.5% of all Welsh exports go to the US, of which most are machinery and transport equipment. Then it's chemicals and manufactured goods, which is not that interesting to the listeners of this podcast, except to say that those are some of the biggest industries in Wales. So if the broader Welsh economy suffers as a result of this, then that's going to trickle down and take me back to the point about consumers having less money, being less able to repay loans, etc., etc. And I think the other point to be made is, to Sophie's point, that funds are going to be deployed much more cautiously from investors of all types based on kind of the lack of certainty in the market. We as a region and as an industry and as a market, that the Welsh fintech industry does receive a far less significant proportion of venture capital, and in fact all sorts of investment, than London and even other regions such as the north of England. So, if it slows in London, that impact is sort of doubly felt in a region like Wales, where we're already kind of further down the food chain, if you like. So kind of anything that affects London or, the major conurbations of England are going to affect Wales, almost significantly more. One thing I did want to say was that the First Minister of Wales said we should keep our cool. And I think that's a better phrasing. She didn't say it in cap letters. She said we should keep our cool. But her other most relevant point and pertinent point, I think, was she said at this point, everybody has to keep all their options open. And whilst that's not bad advice, what that does result in is people not making any decisions. So whether that's an investment decision like on the VC side, whether that's an investment decision as a business, or whether that's a purchase decision, do we go ahead and buy this, piece of equipment that we need? Do we go ahead and, hit go on development on this new project? Do we hire these people? All those decisions just get paused, again, going back to the lack of certainty. And in the UK, we've already seen the kind of negative impact of this towards the end of last year, where we were waiting for a government to give us a budget, but nobody knew which way that was going to go. And that had a quite significant negative impact on business sentiment. And I've got a horrible feeling that this is going to do the same thing. And that's not just in Wales, that's going to be across the board. But again, that kind of like, oh no, what do we do now? We want to keep all our options open. On the one hand, sensible. On the other hand, means nobody makes any decisions.
Yeah, everybody stands still. And I think to your point earlier about recession, it's that classic thing, isn't it? Like if the US sneezes, then the UK catches a cold. And so Wales being disproportionately affected there is definitely going to have an impact. Sophie, maybe just to finish on this one in terms of disproportionate impacts, this is also going to, I expect, impact on, female founders, diverse founders. It's going to have a huge impact there as well.
We're going to end on a high.
Well, no, sorry. It's hard to find a positive in that.
It really is. Yeah, I think it's very similar to what Sarah was saying in terms of what happens when things get tough is that everyone retreats to what they know and the networks that they know, and that it predominantly within venture is white men. Female founders are already receive an astonishingly low amount of funding as it is. Less than 2% of all venture capital funding goes to all female founded teams. And that is just going to get harder given the volatility. I want to try and give a shining light, which is I do think that in times of like macro shift or change, opportunities do open up. In this respect, there's not loads, but I think there will be opportunities specifically with fintech in terms of this difference in trading. Specifically, are we going to be more focused on Europe, and are we going to be more focused on relationship with other countries, less reliant on the US, and have to be innovative in terms of our ability to scale? I think there is a silver lining here. I'm trying to find it, but I think there will be some opportunities that some smart people that are better than me will figure out and take advantage of.
I so appreciate you trying as hard as you did to get us to end on a positive. So I'm going to leave that story there. So yeah, on that note, we're just going to take a quick pause here and we'll be back shortly.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alicabank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Welcome back. Now, before we get back into the news, I wanted to tell you about our latest Insight show. We're looking at the mainstreamification of crypto. As tokenization, stablecoins, and central bank digital currencies, CBDCs, grow in prevalence, is crypto now maturing beyond speculation into a true financial backbone? David Barton Grimley debates this alongside an amazing panel of guests from Coinbase, Zumo, and Fiat Republic. The podcast is out now. Just head to the episode below this one to tune in. Now back to the news. And our next story comes from UK Tech News with the headline, Early Stage Investments Dominate UK Term Sheets. So early stage investments made up 3/4 of UK VC term sheets last year, while the value of late stage funding rounds fell. Seed investments alone accounted for 1/3 of UK funding deals in 2024, according to findings from the annual term sheet guide from HSBC Innovation Banking. The average value of seed and Series A rounds were found to be at the highest level since 2021, at £4.1 million and £17.9 million respectively. This is contrasted with the value of Series C plus rounds, which fell from an average of $211 million in 2023 to $192.9 million last year. To learn more about this research and its findings, we heard from Glen, head of early stage tech and life sciences at HSBC Innovation Banking, who spearheaded the report. So let's hear from him now.
The 5 key takeaways from the report: seed is surging as a percentage of deals. It was 14% in 21, and it increased to 32% in 2024. These deals are more founder-friendly and more competitive. What we are seeing is investor risk appetite also rising at a later stage. So Series C deals increased from 7% in 23 to 11% in 24. However, these are at lower valuations and more aggressive structures. Thirdly, cross-border capital is driving growth stage deals. UK investors are driving seed and Series A deals, but it's European and US investors driving Series C and beyond. Fourthly, what sectors attract him the most investment? Unsurprisingly, it's AI, life sciences, and fintech, areas which the UK is world-class in. And finally, ESG. ESG clauses have continued to rise, so from 22% in 23 to 26% in 24. It'll be really, really interesting to see how the geopolitical environment changes this going forward.
Interesting. Sophie, look, as our resident VC in the room, I guess we'll come to you first on this one. What's your sort of immediate reaction or takeaway?
Yeah, I want to say firstly that I love this report. I think it's so important that founders and investors are armed with data. Negotiating term sheet, if you've ever done it, is just not a nice thing to do. It's complex, it's highly emotional. And so now you have this tool to say, actually, this is the industry standard or this is the average. And it just gives you so much of a better jumping off point for negotiations. So wanted to say that up front. And in terms of the outcomes and findings, I think it's pretty consistent with what we've been seeing over the last couple of years, and actually links back to our last conversation around the IPO market being shut for a long period of time and the lack of liquidity into late stage companies, which means that everyone is going downstream. Because the later you go, the more clear the path needs to be to exit. So that's why we're seeing a little bit of recovery in terms of the Series C. And this is all 2024 data, to be clear. This is not 2025. Because we were starting to see the settling of the market. We were thinking that there was going to be the window opening in 2025. And so investors in the late stage were like, okay, maybe now I can start investing because there is a path potentially to getting the money back. However, previously, when you're not clear about that, you go early stage. And what I've seen as an early stage investor over the last couple of years is more and more funds are doing pre-seed and seed. Funds that you would historically be seed, and that's like Series A, Series B, are wanting to get their better valuations as well. But it's meant that you're kind of having this inflated seed stage, which the likelihood that all of them make it through to acquisition or IPO is very, very low. And you're also getting a lot of competitors being funded, which means that you're creating a lot of competition where probably that isn't needed. So I wonder if, once this IPO market happens, we'll see a resettling of that. But as we've seen, that isn't happening anytime soon. So I imagine that trend will continue.
Does feel like a sign of the times, doesn't it? I think one of the things, Sophie, that stood out for me from what Glen was saying about these being lower valuations and more aggressive structures, do you think that's also kind of reflective of just where the market's at right now?
Totally. There's, as a VC investor, our number one priority is to return capital to our LPs. Therefore, if we are not sure that that is going to happen at the later stages, you need a lot more downside protection. So when everything is going well, forget about the downside protection. We don't care. Maximize upside. We want, the kind of power law, 10% of the portfolio produces 100% of the returns. However, in a market where it's more difficult, you want to squeeze every ounce of capital out of your assets to show your LPs that you're working hard to return capital in a difficult market. And that's where you're getting these lower valuations, these more structured deals. It's all to kind of create an environment where we will, LPs, we will be returning capital. We're trying our hardest.
I love that. Alex, I know this is a sort of UK focused report, but do you recognize some of the trends that it's sort of calling out from the US and other markets?
Oh, yeah, for sure. I mean, I think in the US, I haven't seen the data, but anecdotally, I have seen exactly the same trend that Sophie was describing play out in the US as well, where the uncertainty and just the lack of a clear exit strategy has pushed a lot of investors to look more early stage. And then conversely, when things are going great, you tend to see more firms look towards later stage. You see generalist firms get into specific industries like fintech. So I think we are definitely, and this isn't just relating to tariffs and the most recent economic uncertainty, but even the last couple of years with higher interest rates and a number of issues, we've seen this migration towards the earlier stages. I will say one of the sort of maybe under-discussed components of that, and Sophie, I'm sure, would have some really good commentary here as well, is that these different stages of investing are very different games in terms of the skill set that you need to bring to the table and the value that you add to the company at that stage, right? And so I can completely understand why firms would migrate to an earlier stage in the investment process in terms of their strategy as a fund, but that doesn't necessarily mean they're going to be great early stage investors, right? Because there's a different skill set there. There's a different way that you have to interact with founders, and the value that you provide and the conviction you have to have in your portfolio companies is just very different, right? And so I don't know exactly what the effects will be of less experienced pre-seed and seed stage investors sort of diving into that market. But I think we will see some of those dynamics play out over time with this vintage of companies that are getting funding from some of these new sources.
Yeah, I completely agree. Just to follow up on that, the two things that we're seeing is one, large funds are investing in pre-seed seed, and that's basically an option check for them. So they do not actually give, and they cannot give the time and support to these companies that an actual pre-seed or seed investor could. We're really in the trenches with these companies. We speak to them pretty much every day, and we're really good at that sort of scaling between kind of the 0 to 1. The other problem that we're having is that some of these larger funds, the big name funds like Index Excel, Sequoia, will do these small checks. And then when it comes to the next round, they might not follow on all of them, but that is sending a signal to the market, this company isn't good. Well, they might be really good. It's just they're not be exactly the quality that, an Index or Excel wants, but you've basically written off your company at that point, because what investor is going to invest in a company that, Index and Excel have had, an insight into the company and then don't invest? So yeah, there's some really, really, really tricky dynamics, which founders kind of don't necessarily understand. And so there needs to be a lot more kind of market education around it, which is tough.
Yeah, for sure. Sarah, did any of the sort of sectors that were called out in the report, AI, life sciences, fintech, did any of those surprise you, or were they sort of in line with what you would expect?
Yeah, I mean, nothing was a surprise in there. I think it's this is last year's data, as Sophie said. I think it's I'm pleased to see fintech still being called out, because when you do look at a lot of these reports, fintech is sliding down the kind of the list when it comes to proportion of investment that various industries are getting. So I am pleased to see it on there, but certainly as a UK-focused report, obviously financial services and fintech is still one of our biggest, most innovative industries. An interesting point about AI, and actually this came up at the Unlock VC conference last year that Sophie puts on, and I'm very graciously allowed to attend. But the point that was made there was that there's excitement, obviously, in these technologies among investors, but there's also like caution around the volume of startups and an awareness that many companies are exploring them and they're basing their business models on them. But these are highly capital intensive industries, like models that they're building. And so that means that the smaller VC funds are much less likely to be able to participate in those rounds. And founders really need to be able to explain their USP and their path to profitability in detail. So if you've heard that before, it's because I wrote it in a blog post last October, but it really chimed with me, because this idea that AI is really trendy, great, but it's very, very complicated and very, very expensive. And as we've sort of covered several times already today, investors are being more and more cautious. They want to know more about what they're investing in. They want to see that path to exit. They want to understand the model. They want to know kind of, how it's going to make money, et cetera, et cetera. So that means if you are going to go out there and say, I'm an AI startup, and I'm an AI-based fintech or AI-powered fintech, founders need to be really, really clear what they mean by that. Because whilst it is trendy, investors are becoming much, much more savvy and much, much more cautious about which ones of those they're prepared to pick. And if your model doesn't end up being hugely capital intensive, then you're going to write off a portion of the venture capital market. Just one thing, sorry, to go back to the point that Sophie was making. I think there's a third thing that's interesting about this trend towards seed and pre-seed, however you want to define it, because everybody has their own definition of that. And I think that's, and Sophie, again, will know more about this than me, but I've observed quite a lot of talent moving around. So some of those larger firms that we were talking about that are thinking of moving down into seed and pre-seed are scooping up some brilliant talent that might have been at more bespoke, more niche, smaller VC firms who have that kind of, to your point, Sophie, time and effort to dedicate to their portfolio. And they're being sort of scooped up and taken somewhere bigger. And it's going to be really interesting to watch how that talent moves around and how it kind of, where people end up and where it has the most impact. Because the last thing you want is to take an absolutely brilliant person and drop them in the middle of a huge firm and for them not to be able to have the impact that you'd love them to have. So I think that's another trend to watch, is like people moves within the VC industry.
I love that point about talent. And actually, Sophie, I know I've got to sort of move on from this one, but just the point on AI, like what is sort of investors' views on AI at the minute? Because obviously I think like it's got to sort of like next level of sort of buzzword, and sometimes you talk about it and people roll their eyes and stuff. But I think actually, if you almost like shift focus from just talking about the technology and really focus on the use cases, then it becomes a lot more interesting.
Are you going to completely correct me now, Sophie? I feel like I've completely changed my mind.
It's very different investing in a AI LLM, so like a Anthropic or an Open or a ChatGPT, to an AI business, and it really I'm almost like, it's slightly silly that AI is its own. It's not a vertical. It's an underlying technology. Do you remember? Take us back 10 years ago when we were doing this bloody blockchain. It's like, as a blockchain business, okay, but what are you actually doing? So I think it's the same with AI. But I think the thing that I would sort of counter a little bit, which is, it's never been easier or cheaper to build a business now because AI can do it for you. And so it is actually reinventing the startup game and kind of leveling the playing field. You can get an MVP built with Lovable in a day. You can do your marketing plan like with ChatGPT and it'd be fine. So you can start with a way smaller team, scale way quicker, and be way more capital efficient. So what does that mean for the venture capital industry? And how does that play? How should we rethink about our models in terms of capital trajectory and funding? And we're still at such the early stages of this. So I think I'm not going to put my hand up and say I know everything that's going on, but I do know that we are in a kind of fundamental shift in terms of like how we view the whole asset class and the whole asset class of startups. So it'd be, I guess, watch this space with interest.
I love that. You're really bringing the optimism. I was going to say, I assume that those questions that you were asking there were, you're not expecting an answer on those. But definitely.
But if anyone does have them,
yeah, exactly.
drop me a line.
Definitely one we'll keep an eye on. All right, super. I'm going to move us on to our next one. This one comes from Reuters with the headline, Brazil Central Bank to launch PIX installment feature in September. So Brazil Central Bank announced a new feature allowing users to pay for transactions in installments through its widely popular instant payment system, PIX, and it'll become available in September. Quote, the feature has the potential to boost PIX usage in retail for higher value purchases, benefiting those without access to traditional credit options. That's what the central bank said in a statement. Paying for purchases in installments is deeply ingrained in Brazilian consumer habits and has long been a key advantage of credit cards. According to the central bank, the so-called PIX Parcelado will be available to both consumers and merchants. I'm going to assume that PIX Parcelado probably sounds better in a Brazilian accent, so I apologize. Alex, I'd love to get your thoughts on this, because I think in a similar way to what Sophie was saying before about the potential for AI to sort of upend everything, this is having a huge impact on payments already in Latin America and the potential to sort of really go quite a bit further.
Yeah, absolutely. I mean, the PIX is remarkable, right? Because it has actually overtaken both debit cards and credit cards in Brazil from a transactional volume perspective. And so it's the dominant payment form in Brazil these days. And it supports B2C, it supports B2B, it supports P2P payments. Like it kind of covers all grounds as it relates to payments. And the central bank in Brazil has made it incredibly easy for businesses and for consumers to use it, largely by mandating that banks will support it, which is something that we don't necessarily always do in other countries, but the central bank in Brazil does that to great effect in this case. I think my takeaway on the installments is, as you pointed out, installment payments at the point of sale has existed in Brazil for a long time, much longer, in fact, than sort of modern BNPL has existed in other markets. And so Brazilian consumers are used to thinking that way about financing and about lending and about payments. So it fits into a very natural payment behavior that already exists in market. And I would say Pix's ability to play a role here is really just an indicator that in a lot of cases, payments is the tip of the spear for other things that follow on, right? So if you capture payment volume, if you capture payment activity and payment behavior, you can tie a whole bunch of things onto that, right? Most forms of lending in a retail context are just extensions of payments, whether it's credit cards or BNPL shopping at the point of sale. It starts with payments and then it sort of backs its way into lending. I think the question that I have is, how will this be implemented from a bank perspective, right? Because obviously this is a bank-to-bank payment network. That Pix is supporting the ability to do installments is fantastic, but you still need someone, presumably a bank, to be lending money to borrowers. How are they going to evaluate those borrowers? Does the infrastructure exist at the banks for them to do that? How interested are the banks in extending loans to those customers at the point of sale? And, how much will banks take into account like transactional data, a lot of which comes through Pix now as the primary payment method in Brazil? How much are they going to take that sort of transactional data or open banking data into account when they're making those lending decisions? So I think the back-end infrastructure is where I have more questions, but in terms of the front-end experience for Brazilian consumers, I think it's going to be a seamless fit.
So at the risk, just to follow on to your point, Alex, banks already offer installment payments through Pix in Brazil and have done for a while, which I only found out when I was researching this story. The difference is going to be that they set, to your point, that they set their own terms and conditions. Whereas when this comes in June, supposedly, I don't know if the Brazilian central bank is better with its timelines than most of the other central banks I've come across in my time, that there will be centrally dictated conditions under which they are,
that's so
under which
interesting.
they can offer this service. So some of the largest banks in Brazil and some of the larger fintechs as well already do offer it through Pix, but they get to set the terms and conditions. So that's what's going to be interesting. And sorry, I didn't mean to correct you, but I found this nugget earlier, and I thought it was really interesting.
Yeah, I'm learning in real time. That is fascinating. And I think maybe one point to add on top of that, that's so good to know, is there is this trade-off that exists country to country about how prescriptive regulators are versus how much they allow the market to dictate things, right? And I'll just speak for the US. In the US, we're very much like market-led, right? Like regulators are not prescriptive. We introduced FedNow, which is our real-time payments rail operated by the Federal Reserve. The Federal Reserve legally cannot mandate that banks in the US adopt FedNow, which is insane, right? So if you go to conferences like Money 2020, you will actually see the Federal Reserve have a trade show booth on the exhibit floor trying to sell FedNow to the banks that they regulate. They can't tell them to use it. They have to sell them on it. That is just an entirely different model than, Sarah, what you described in Brazil, where the central bank basically sits down and says, okay, you will support this payment system. And then, you guys are doing installments through Pix. That's great. But we want to mandate a more regimented way to do that. And they have both the authority to do that. And from what I can tell, at least externally, the Brazilian central bank has a pretty effective working relationship with banks and fintech companies in Brazil. And so I don't know if they're going to hit this timeline either, but the success of Pix to date would suggest that they probably will.
It's interesting, isn't it? Because when you look at, I suppose, success stories like certainly the early days of open banking in the UK or UPI in India or, sort of Pix in this instance, that mandate's kind of at the core of all of it, right? To be able to get that scale and actually really drive, sort of adoption. That's the sort of key component, right?
Yeah, I think absolutely from my perspective, and I think it's really interesting. If you look, I fell down a bit of a rabbit hole on this one. If you look at the roadmap, they also talk about their CBDC, the Brazilian Central Bank CBDC, but I won't go into that. But the other thing that they're going to introduce as part of that roadmap is a recurring payment feature. Now, for those who have any insight into the UK's open banking regulations and system, and I've been looking at this for way too many years, but variable recurring payments is something that the UK open banking infrastructure has been desperately trying to implement for almost years at this point. Whereas the Brazilian central bank has gone, right, no, it's here on the roadmap. And I'm 100% faithful that they are going to get there and do it before we do. And we've been talking about it a lot longer. So my take on this is that you could do a lot worse than watch Brazil for what open finance should look like in the future. There are questions, I totally agree with Alex, about whether it should be market-led or centrally driven. Centrally driven seems to get stuff done quicker.
Yeah.
Whether that means it's done the right way is a whole other kettle of fish. But I think it's a really, really interesting implementation of open finance, and one of the most advanced ones we've seen. And also that's implementing actually useful stuff. Because some of the open finance things that you see talked about, there's like, well, that would be great, but that's not actually going to help me day to day. Is it going to help me manage what is essentially what we'd call here a direct debit payment, that goes directly out of my bank account without me having to fill in forms and instruct various banks and whatever else it is? Absolutely, that'll help me on a day-to-day basis. So I get quite excited about watching Brazil generally, but PIX is a really, really interesting example.
Yeah. Sophie, what stood out to you on this story?
I am definitely not as well read as Sarah and Alex here, but I think the what always interests me is, one, payments is never done. I love that we're still innovating in payments. I think we'll never stop be innovating in payments. But two, how I think it's just so common now, we're seeing these payment companies move from payments to platform. And it's like, okay, payments is the wedge in. And then how do you start building kind of features and, embedding other financial products into your products so that you can, expand your unit economics, cases to different customer groups, and also support, your merchants. So this is a huge thing for merchants, who will probably enable them to sell more products because they can offer this product. So it will be interesting to see kind of how they continue to use the platform that they have to build other products and features and keep expanding.
Yeah, because typically when you introduce something like installment-based lending at point of sale, we see sort of like the total value of baskets go up. We see less dropouts at checkout. So there's definitely an upside for merchants here. And Alex, I was struck, when you were saying at the top of this story about payments being the tip of the spear, and Sophie, I think you just articulated it really well as well. And I think what we're talking about here is on the consumer side. But to your point about the data, and if you look at like POS providers like Toast or someone like that, and actually them having that data and then the opportunity to be able to do sort of lending on the merchant side, again, I think is a sort of really interesting prospect. Not necessarily what we're talking about in this story, but I think sort of illustrates maybe the point that you were making about payments being the tip of the spear.
Yeah, I mean, payments generates data, and data is really valuable for lending, right? Is kind of the easy way to say it. And so I think this potentially is a really rich way to underwrite loans. And I'm fascinated by what Sarah shared about this being more sort of centrally organized and sort of regimented from a lending perspective, because I think the other thing that we see a lot in the US is when it's market driven, you are sort of subject to whatever the incentives are, right? And so in the case of like BNPL, which I know has been a topic that's come up a lot on this show over the years, the question is always, well, if it's merchant funded, then merchants have a different incentive than consumers. And this might be a mechanism to sort of push consumers into debt or encourage them to buy more than they otherwise would. I'm really interested in digging in and learning more about the way that the Brazilian central bank thinks about installments, because obviously as the central bank, they want to encourage economic activity. They want to encourage it to be easier to transact in their economy, but they also have a mandate to like protect consumers and to make sure that consumers aren't getting into too much debt and to care about the financial health of Brazilian consumers. So again, this idea of, is it market driven or centrally planned? There might be a benefit to being centrally planned in terms of balancing the incentives between consumers and merchants.
Yeah, I love it. And I think you always have to sound that note of caution when it comes to any sort of lending. I know whenever it does come up on the show about BNPL, we do that. Sarah, one quick final word. I'm just interested. I mean, it sounds like installment lending or paying for things in installments has been culturally quite significant in Brazil for a long time. And the predominant, I suppose, tool that they've used to do that has been credit cards. But when we see the, accelerated adoption of something like Pix, is it natural to assume that the sort of credit card providers are going to lose out?
I think credit card providers have hugely lost out to Pix already. Excuse me. And you only have to look at, they've lost out to Pix, but also if you look at companies like Nubank and, the success they've had in those markets as well, the traditional credit card providers have certainly already lost out significantly. And I can only see that their market share is going to continue to shrink with kind of Pix offering this service as well. I think what people forget is also that installment payments are quite embedded in an awful lot of cultures. In fact, if you look at the United Kingdom, it wouldn't be unheard of for, my grandparents to go and buy their white goods in installments, to go and buy their fridge or their sofa or their television in installments. Like, it's just the way we do it. So I think it's the way in which it's implemented. And I think Alex's points are really, really relevant. It's how you do it and how do you make sure it's a benefit to the consumer without being a loss to the merchant? Because you've got to have that balance if you're going to offer that kind of service. So it's going to be interesting to see what happens next. I will hold my hands up and say I'm not an expert in the Brazilian credit card market, except that I have heard that they are generally not happy about all the innovation that's going on around them, having had many, many years of kind of essentially a monopoly and significantly higher interest rates on credit cards than you see almost anywhere else in the world. And they're being forced to rethink their models. So definitely interesting to watch.
Yeah, it's moving pretty quick. Okay, now for a quick look at one more newsworthy story this week that we don't have time to cover in full. This one comes from the FT with the headline, Singapore startup Airwallex to seek UK and US banking licenses. The $5.6 billion Singaporean payment startup Airwallex has let out plans to seek banking licenses in the UK and US to expand into lending and compete with global banks. Chief Executive Jack Zhang told the Financial Times that the company is ready to apply for a UK banking license and would later seek to obtain a US one by buying a bank. Airwallex's growth has largely relied on payment licenses so far, preventing it from offering credit at scale. It is now seeking to expand into lending and is trialling a credit card in Australia. Any product that a global bank has, we will have, said Zhang. Ultimately, in a decade, I think we're going to displace some of the global banks. Yeah, look, it's a bold statement on this one, and I think you've only got to admire the ambition. I mean, you can tell that they're not going to attempt to do things by halves, and I think that's underscored by the fact that they're going for banking licenses in markets like the UK and the US, markets where they have real potential to solve for some pretty knotty problems. But of course, obviously, options to massively scale. It's interesting. Ultimately, in a decade, I think we're going to displace some of the global banks. I think that has to be the North Star that businesses like Airwallex are reaching for, and it's definitely one that we'll keep an eye on into the future in terms of how this one develops. Okay, now it's time for our And Finally, which is always something a bit different. The headline comes from FinExtra. Toulouse lets commuters pay for travel with crypto. Public transport passengers in the French city of Toulouse can now pay for their rides in Bitcoin. In a European first, the city's public transport operator Tiseo, again, apologies for the accent, has rolled out a system that lets people pay for metro, bus, tram, and cable card tickets using a host of different cryptocurrencies. Tickets can be purchased on Android devices, with a third-party provider converting the crypto into euros. Sarah, I'll come to you first on this. What do you think?
I don't understand. Kind of, crypto is very volatile. Like, how do I know how much my commute's going to be? Like, I've lived in London for a long time, and where I live now, we have that when you tap your card, the maximum it's going to be that day is, X amount. Like, how do you I don't know how you know how much your commute's going to be. Like, do you have to like check your app and then just wait to get the train just when the exchange rate is right? I'm not an expert in crypto at all, but like that's the thing that came to me was that like if it's 0.0001 of a Bitcoin every day, that could be the difference between like €10 and €150, especially given what's happening with the markets at the moment. So I'm sure somebody cleverer than me has worked that out. But as a consumer, were I to turn up there and be offered that choice, I'd be like, no, thank you. I will stick with my debit card and I will pay in euro.
Yeah. I mean, you'd like to think someone's worked it out, right? Or else Toulouse is quickly going to go under.
It could be brilliant. It could be a really good way for Toulouse to like gather loads of Bitcoin and build out their assets. I don't know.
What do you think, Alex?
Yeah, I agree. I mean, the thing I would add is that at least in the US historically, this might change over the next 4 years, but when you sell your crypto, that's a capital gain and you have to pay taxes on it. So like you're adding a whole other layer of complexity every time you liquidate a little bit of your Bitcoin in order to buy a sandwich, or in this case, a bus pass. So I don't really understand what the benefit of that would be. I think that stablecoins are different, right? Because stablecoins don't have the volatility of other currencies. But then if you're using the stablecoin to pay for this, why aren't you just using euros, right? Like you can kind of pull on this thread and go, we already have a great solution over here. Why are we bending ourselves out of shape to do this other thing that's not the best way to pay for something? So I share Sarah's befuddlement.
Yeah, I mean, look, that's kind of my reaction as well, right? It seems to be sort of forcing a use case. What do you, like, Sophie, do you think this is something that people are going to, like, are we going to see mass adoption of paying for commutes with crypto in Toulouse?
I can't imagine we're going to see mass adoption, but I do think the interesting thing here is I imagine that Toulouse is going to see an influx of like crypto enthusiasts. That's the word. I was going to say crypto bros. That's not the right word.
Same.
I think both could be used. I think both could be used.
And maybe that is its like sneaky little thing is we'll just drive some crypto tourism to Toulouse. Why Toulouse as well? It's very strange that Toulouse is the first city to implement it. But yeah, I can't imagine. I hope that doesn't, the UK doesn't see this as an interesting way to improve tourism because, yeah, it's a headache.
Yeah, it's interesting, isn't it? Because this isn't. We saw the example recently of being able to donate on just giving using crypto, and again, I mean, Sarah, that doesn't feel like the most natural use case for your cryptocurrency.
I mean, hey, you could look really, really generous depending on like when the transaction settles. I do wonder if that's also exempt from capital gains tax because it's a donation to charity. And in the UK, when you donate to charity, you get if you do that, then your tax return looks significantly better. So I can almost see that. Logic more. But again, it does. To be fair, it does say in the article, I haven't looked at it properly, a range of cryptocurrencies for the Toulouse transport. So it may be that there are some. It may be that this terminology is, very broad, and there are some stable coins in there. I don't know.
Meme coins. It could go the other way. Like, I want to pay with all of my meme coins that are worth nothing, but can I aggregate them all together and buy a bus pass with them?
There must be something happening in Toulouse that we don't know about, and that's what I'm now going to take away from this evening is what's going on in Toulouse. You
guys need to do like a field trip and like investigate what's happening.
It's a beautiful city. I'm up for it.
I love the idea of scrabbling all of your meme coins together. It's like the digital equivalent of like scrabbling down the back of the server to get you. All right, nice. Sophie, I think we managed to end on a positive, so that's good.
Yes, good work, crew.
That wraps up this week's FinTech Insider News. Thank you so much to today's wonderful guests. Where can people find out a bit more about you and your company? Sophie, let's start with you.
Yes, mostly on LinkedIn, Sophie Winwood. If you want to find out more about Unlock and the summit, which Sarah mentioned, you can go to unlock-vc.com. And then in terms of if you're an early stage FinTech founder, pre-seed seed, foxcapital.com.
Amazing. Thank you, Sophie. Sarah, how about you?
So again, I'm largely on LinkedIn, Sarah Kocianski. You can find more about FinTech Wales on fintechwales.org. You can also find the application form for the Foundry over there as well. As I said, if anybody's got any questions on that, then please do reach out.
Definitely check that out. We've definitely got a couple of good seamless plugs in as well in this show, which is always good. Alex, how about you?
I will shamelessly add a plug too. I'm on Twitter and LinkedIn, Alex Johnson, and then my newsletter and podcast, Fintech Takes, which you can find at fintechtakes.com.
Super. Thank you, Alex. As for me, you can find me on LinkedIn, Ross Gallagher. And for 11FS, you can find us on 11FS.com. Thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or friend? As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider or email podcasts@11fs.com. Thanks again and goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alicabank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.